Welcome to AI Finance Daily, the show that makes AI economics make sense. Most people are getting this wrong. Today, we fix that. The subject, AI in finance. How banks are using models to cut costs. And the risks they're hiding. 94%. That's the share of bank CEOs who told McKinsey they're investing heavily in AI. Yet only 16% report seeing any meaningful return on that investment. The gap between AI's promise and its reality in banking reveals something crucial about where this technology actually creates value and where it destroys it. Let's look at what's really happening inside these institutions. Major banks are currently spending between $100 and $300 million annually on AI initiatives. JPMorgan alone has reportedly allocated over $12 billion to technology investments broadly in 2024. But here's where it gets interesting. The successful deployments aren't coming from the flashiest projects. The real returns are emerging in three specific areas. First, fraud detection. AI models are catching patterns humans miss, reducing false positives by approximately 60%, according to industry analysts. Second, customer service automation. Not replacing humans, but augmenting them by handling the routine queries that consume roughly 40% of staff time. And third, algorithmic trading optimization, where machine learning models are improving execution efficiency by what Goldman Sachs estimates as 10 to 15% in certain markets. But there's a shadow side to this transformation. The same AI systems that detect fraud can also create new vulnerabilities. We're seeing what security researchers call model poisoning attacks, where bad actors deliberately feed misleading data to corrupt AI decision systems. The financial stakes here are enormous. A compromised trading algorithm could potentially lose millions in minutes. Here's what separates the winners from the losers in banking AI adoption. These successful institutions start small, with clearly defined use cases that have measurable ROI. They build robust testing frameworks before deployment, and critically, they maintain human oversight at key decision points. The failures? They often come from trying to transform everything at once, or from treating AI as a magic solution, rather than a tool that requires careful integration with existing processes. Looking ahead, the next 3 years could reshape how banks operate. The convergence of large language models with traditional banking infrastructure may reduce operating costs by what Morgan Stanley estimates could be 15 and 25% in back-office operations. But this isn't just about cost cutting. The real opportunity lies in creating new products and services that weren't possible before. Consider what's happening with credit scoring. Traditional models typically use 8 to 10 variables to assess creditworthiness. Advanced AI systems can analyze hundreds of data points, potentially expanding access to credit while actually reducing default rates. Early trials at several regional banks suggest default rates could drop by 20-30% with these new approaches. But here's what keeps risk officers awake at night. These AI systems are often black boxes. When they make decisions, particularly in areas like loan approval or trading, regulators want to know exactly why. The banks that will win are those building explainable AI systems from the ground up, not trying to retrofit transparency after the fact. For investors watching this space, the key metrics to track aren't necessarily the size of AI investments, but rather the efficiency ratios and risk-adjusted returns. Look for banks reporting specific, measurable improvements in their operational metrics, not just broad claims about AI transformation. The figures and trends discussed here are drawn from publicly available industry reports and regulatory filings. But remember that technology deployment outcomes can vary significantly between institutions. This analysis is meant to educate, not to provide specific investment or business advice. The key is to maintain a balanced perspective. AI in banking isn't a revolution, it's an evolution, and success requires patience, precision, and pragmatic expectations. AI Finance Daily. Thanks for listening. If this episode added something to how you think about AI and money, follow the channel. There's a lot more where this came from.